And one final question, going back to the Parliamentary Secretary, to the Finance Minister. I would like for you to comment just how important it is for our government to ensure that we have a sound and stable housing market.
Thank you. Well, first and foremost, when these policies or these changes were brought forward, they were brought forward because we want to really help support a healthy and stable competitive housing market within our society, and also to make sure that our economy is stable as well. We have put measures in place to protect borrowers because we recognize that there's a high level of debt, and we truly just want to make sure that we're here to protect Canadians. That's what it's all about. It's about protecting Canadians and making sure that they have a stable debt load.
So the president of the CMHC just said that the changes that were brought in October 3rd were not in response because of Toronto and Vancouver's housing markets. You, in your opening statements, have said otherwise. Who's right?
My comments with respect to this is that I can tell you that we have seen that the situation was acute in Toronto and in Vancouver. However, the borrower vulnerability is not just in Vancouver and in Toronto. The borrower vulnerability is all across Canada from coast to coast to coast. Those markets were hot, yes. However, it's the borrower vulnerability that we're very concerned about, and that's why these policies and these changes are put in place.
The president just said completely otherwise, that the changes were not made because of those exclusives, but we'll move on. Now, some of the best advice I ever received was to think of people, not for them. And when I read this, sir, it sounds like your agency is thinking for people. Action was needed to address the level of household indebtedness in Canada, which is now a historic high of 167%. Now, that may be, that is probably true, but it doesn't necessarily address housing debt. We've had witnesses after witness come and say that when someone can get into the market, and I'll just bear in mind that many people, the baby boom generation, came in at double-digit interest rates, and they did so because they felt, A, a home gives them a place for their family, for safety. Second, it allows them to put away money into a forced savings, so to speak, and allows them to have the privilege of home ownership, which I think is important. And I think what you're doing here with your comments, sir, is you're somewhat construing the situation to sound like it is all mortgage debt that is causing the problem, when we've heard very clearly that access to credit card debt, access to financing loans for for cars or for other non-durable goods, unlike a home, I think is an issue. So when you say highly indebted borrowers are likely to be younger first-time home buyers, are you not also saying that when people finally get into market, they're going to be older and they're going to be kept out of the market for longer? I'm just trying to get a sense of where you're going with this.
So in Canada, we have among the highest home ownership rates in the world at about 69%. And indeed, as you suggest, home ownership is well correlated with various social outcomes, including forced savings, retirement wealth, etc. We took as quite instructive the research being done by the Bank of Canada that the number of people who had very high credit scores that were entering the housing market had grown from 4% of people who were indebted to 8%. First-time homebuyers in particular tend to be substantially, I think it's 90% plus mortgage debt as opposed to other sources of debt because they're quite stressed. And so we were concerned about their ability to afford their homes. And I don't think we were thinking for them with respect. I think we were very much thinking of them.
I would disagree simply because when someone is young and they've most of the time they have some education debt that they have to pay off for school, but then they usually, when they're buying a home, it's usually because they're on a path, they may get a promotion, etc. And also, I will say, like the baby boom generation, they got into the market knowing what the risks were and made sure that they could make those payments even when they were dealing with double-digit interest rate. I think, again, the policy somewhat smacks of the nanny state. Now, what evidence does CMHC have that supports your contention that portfolio insurance has distortionary effects which are stimulating excess credit and contributing to higher levels of household debt?
There were a number of business models that were substantially based on, for example, refinancing, and I gather some testimony has referred to refinancing as something that has been lost. I just want to distinguish between renewal and refinancing. So if an individual comes to the end of their mortgage term and seeks to renew, they can still do that. That's freely within the programs that we have in homeowner transactional and portfolio insurance. Refinancing is where somebody goes to a bank and wants to borrow money and increase their amount of indebtedness out of their home. And our contention is that's not a housing need, which we think CMHC exists to provide. That is a housing want, and that can be provided and still is freely available in the public markets. But to the extent there's government support for it, that didn't strike us as something that the government should be supporting.
Oftentimes when someone's need to renew, they're at the end of 5 years and they often have the equity already to be able to pass because they've hit that 5-year period. But again, part of refinancing allows for people to be able to invest in their small business. It allows them in some cases to survive a lockout or a strike. It sometimes will allow them to be able to purchase a home from a spouse because of a divorce. So I just think it's a little bit short-sighted for us to look at those. And what evidence of risk was present to eliminate portfolio insurance on refinance and rentals when there was a delinquency factor of 0.24 of 8% in the current portfolio?
So the evidence